Right. So once again, welcome to our first session for FAC 3764 in the 2025 academic year. My name is Mr. Privilege, and I'm the tutor with Grad Consulting that will be facilitating you colleagues with regards to this module. So without any further ado, guys, I want to introduce you to the first learning unit. It does actually form part of your year test, number 1, which you're going to, it's actually assignment 1 anyways, right? Because remember with FAC 3764, it's a module arrangement. So a module arrangement, what it means is it's a module that is set up in such a way that you would have to submit several assignments. Some will be done under exam conditions. Some it will be just typical quizzes that you may need to complete on the portal. So you're gonna find a compilation of that set up in terms of structure of this module. Now, but of course, for the purpose of those assignments that are written, which will be more like year tests, it's important for you to have a thorough understanding of certain principles, such as the one that we're going to be looking at today. So I want to also quickly open up my notes as I pointed out. Yeah, I think it's done converting now. Okay, there we go. Right. So today I want us to have a look at learning unit number 1. So learning unit number 1, colleagues, it deals with a very interesting concept, which is the concept about the conceptual framework for financial reporting. It's very important to have an understanding what the conceptual framework really is, and the basis of reporting that companies are expected to follow or they're expected to use. And we also, of course, look at the items or what I call elements of the financial statements that would affect the financial statements that you would see according to the IFRS standards, right? So it's very important to have a look at that. So, but this material that I'm portraying currently, this is really the material that we have on my UNISA. So it's a really something that you can also go through on your own, which is one of the reasons why I decided to do a summary. On the other hand, to expound further regarding to the concept. So this, you can use it as a guideline. So obviously they've given you some guide around it to say when you see these icons, because you're going to come across these icons as you go through out the different learning units in this module. So it's very important to have an understanding of this. But this is really for your own personal study, because I'm not going to take you through the study guide. I believe that as a student, you can do that on your own. The only part where I'll then take you to the learning units or study guide, it's really the part when we do questions. For instance, those questions at the end of the study units, at least when we do those kind of questions, just so that you can be familiar with how they test on the concept or on the principle. That's the only part maybe that we can focus on. But some of those questions, or most of those questions, really you would find them when you go on my UNISA. So that's where most of those will be provided. I do have some questions in there that we can also use, just to ensure that your understanding of these principles is sealed. So, anyways, without any further ado, let's quickly go through the conceptual framework and see the dynamics around this. So these are key essential learning objectives or learning unit that you need, learning objectives rather, that you need to have achieved by the end of this discussion. Number 1, you must be in a position to discuss the objective of general purpose financial reporting and the qualitative characteristics of useful financial information. And by the way, this very same learning unit 1 we are looking at, you find it in chapter 2 or topic 2 of your textbook. So this is topic 2, or rather chapter 2 in your gripping gap textbook. This is basically the source of my notes. that the note summary that I did here, I did it according to your textbook, right? So obviously, just as a point of reference, you can also go through that in your own time. But however, this is what you're going to see just as an outline. So they'll talk about the conceptual framework, what is the purpose, the objective, and the concepts of note. They'll explain what is general purpose financial reporting. And then we'll look at the different forms of financial statements, right? So you've got 4 of them in nature, which is something you already know from FAC 2601. That's where this concept and principle was introduced. So you've got a statement of financial position, statement of financial performance, which is really the statement of profit or loss and other comprehensive income. You've got other financial statements, such as the statement of changes in equity and what else? Statements of cash flows. So that's what you find here under other statements and notes. So far, so good?
Yes, so far, so good.
Wonderful. Then, of course, we will also talk about qualitative characteristics and quantitative characteristics. But essentially, which is very important, which I've noticed to be one of those areas of notes that are tested in the exam, the elements of financial statements. So this part of this topic, trust me, it's very, very important. So I'll mark this as NB. Excuse me. This is NB. Why I'm saying that, because they will bring you, look, your question in the test, it will be integrated normally. So they will not just be testing on the conceptual framework. They will test on other things as well. Like you may even be required to do financial statement of financial position, for instance. They might even ask you to do something to do with the statement of profit or loss and other comprehensive income. And then they'll pitch in a question that tests you on the conceptual framework. But normally, when they pitch a question of that nature, it will be a theory question, discussion type of a question for that matter. And what they'll just want you to do, for instance, it could be just a case whereby you need to evaluate whether a particular transaction in the context of the question qualifies to be considered as an asset. In other words, you need to assess that transaction on the basis of the elements or attributes of what makes up an asset. Or it can be maybe on the basis of what makes up a liability, or on the basis of what makes up equity, or on the basis of what makes up incomes and expenses, you see? So it's very, very important. They can ask you anything around that. So what is key, which you need to take note of as you go through, especially this part of the textbook in topic 2, you need to just check to say, okay, what are the elements or attributes that makes up an asset? What are the elements or attributes that makes up a liability? We're going to talk about them. So when you're saying attributes or elements that makes up an asset, for instance, we're really talking about the definition of an asset. So I'm going to expound further on that in detail, in a greater detail, as we go through the note that I've already prepared for you guys, right? So now, without further ado, so I think, yeah, this is important. Trust me, it's very important. It can be a 9-mark question out of a 40-mark year test or assignment. And now it's going to be a 9-mark question out of 40 marks question. So it's quite important. I saw that in the previous year test for 2024. I just have it on the other laptop, but I'll share it with you on WhatsApp and you'll see it. Right. So now let's come back here. So these are the assumed knowledge. So the assumed knowledge is basically important detail that you need to draw from the concept that we're going to discuss. It can also be the learning outcome. So these are the important ones that you need to know. Discuss the objective, general purpose, financial reporting, and the qualitative characteristics of useful financial information. You can get a quiz question around that. Identify the reporting entity and its reporting boundaries, right? Apply the definitions of an asset, a liability, equity, income, and expenses, like I mentioned. This is very important. And then, of course, apply the criteria for including assets and liabilities in the financial statements. In other words, the recognition criteria, very important. This connects together with that. Because yes, you need to know the definition. That's important. But then the recognition criteria, it's also equally important to say, how do you recognize an asset in the phase of the financial statement? Which statement, or rather financial statement, would you find assets being disclosed? Obviously, it will be in the statement of financial position. And how are they captured or recorded there? Are they captured according to the historical costing model? Are they recorded at the fair value model? All those kind of things. So that's what you'll be discussing when you are dealing with the recognition criteria of recognizing an asset or a liability. And then also, when you are de-recognizing an asset, which normally happens in the case where you sell an asset, how do you go about doing it? What is the de-recognition process that you follow, to get rid or to remove rather an asset out of your books? Same thing with the liability. Liabilities usually get de-recognized out of the books of the company whenever we settle the debt that we were owing to a creditor. So when we've settled that loan payment, how do we capture that information in our financial statements? So that's the de-recognition process that you need to be able to explain, right? And it goes further and further to explain the measurement basis, which is where I mentioned about the historical costing model, the fair value model, which is also commonly known as the carrying value model. We're going to talk about that later. And then they explain the concept and guidance on presentation and disclosure. How do you present assets in the financial statement of financial position in that matter? Communicate clearly and concisely in a professional manner appropriate to the audience and situation. So this is in a case where you get a question and they want you to explain how you're going to recognize a transaction in the phase of the financial statements. That's this part. So obviously, one of the things, let's say you're dealing with a transaction that involves an asset, right? You first list the definition of an asset. That's how it goes. After you've listed the definition of the asset, then you begin to expound whether or not the transaction meets those criteria of the definition of the asset. That's the second part of it. After you've done that, you then give a conclusion of whether you can be in a better position to say, yes, this transaction qualifies to be recognized as an asset in the face of the statement of financial position of the company, or you can argue to say, no, this particular transaction does not qualify to be constituted as an asset in the face of the statement of financial position of the company. But remember, they have to be facts to support your conclusion. So it's very, very, very important to note that. Then, of course, communicate and collaborate with others using a wide range of digital devices, technologies, and platforms. So this is where, those discussion forums on my UNISA comes in. So you're going to be doing some discussions on the forums. So it's very important to comment on that as well. You get some marks, I believe, for doing that. So just make sure you constantly checking your announcements on the platform just to see, if there's anything specific that the lecturer posts that you need to be aware of. Right. Apply the effective listening and discussion techniques to obtain and clarify relevant information. Yeah, it's similar. It's still talking to this, or rather communicating to the use of technologies and platforms, right? Because there are going to be certain moments or certain instances where you would have sessions with the lecturer as well through Teams on my UNISA. So you need to make sure you are constantly up to date with regards to that. So far, so good, sir.
Yes, so far so good.
Wonderful. So remember, I pointed out that this particular learning unit, it's part of chapter 2 of your gripping gap. But remember, this is the 22 version that I had used to do my notes. But remember, every year they post a new version. So currently there's a 2025 gripping gap version. So I've not looked into that one yet, the one for this current academic year, as to whether it is the chapter 2 or maybe they might have just changed the chapter structures per se. But for the purposes of the notes that I had structured for you, guys. It's actually chapter 2 of your 2022 Gripping Cup textbook. I have that version. It doesn't change that much, by the way. Right. General purpose of CF. Right. So now, to be helpful, to be a helpful resource to the international accounting standards in their development of the IFRS. So general purpose of what? So let me take you there so that you can see it from your textbook. So it's really dealing with this. Sorry, conceptual framework. That's what it means. General purpose of the conceptual framework. Why do we have a conceptual framework in accounting? That's what CF means. Conceptual framework. So I just abbreviated. I didn't want to write the whole thing in full, right? So what is the purpose of a conceptual framework? So number one, it's helpful. It's a helpful resource rather to the International Accounting Standards Boards, which is the ISB, when developing the IFRS. So in other words, when the when the standards, the International Financial Reporting Standards are being formulated by the IASB, they ensure that the standards are confined to the requirements of the conceptual framework. So in other words, the standards should not be in violation of the general conceptual framework of accounting. And number two, the conceptual framework is helpful to help preparers financial statements to create their own accounting policies. So it helps in policy formulation for companies. And it is also it's also helpful to everyone. That is, of course, the ISB, the preparers of financial statements themselves, and even the users of financial statement to what? Understand as well as to interpret the International Financial Reporting Standards. Right. But look, this is just for theory purposes. You can be tested over a quiz question, but in a written question, not so much about it. But yeah, I just thought, let me just point it out. Now, RE stands for reporting entity. So what is the general purpose of financial reporting itself? So first of all, we spoke about the general purpose of a conceptual framework. Now we are talking about the general purpose of financial reporting. Why do we have financial reporting in the first place? Right. So the financial reporting is just there to ensure that there's provision of financial information about the reporting entity. So financial reporting allows financial information to be generated or to be provided by the reporting entity to its interested users. Now, who is it going to be useful to? Who are the users of this financial information? Obviously, it's investors, lenders, as well as other creditors to the company. And why do these people need that information? So that they can be able to make informed decisions that is relating to either providing resources to the entity. I mean, if you look at it this way, lenders, for instance, would provide debt to the company, right? Or credit to the company. Credit, it's a form of resource that is in monetary terms given to the company. So before a lender or a creditor rather provide their resources to the company, they need to assess or they need to evaluate the financial information of the company to say, are they in a position that they can be able to repay back? Suppose we give them the resources that they are requesting for. And then on the other hand, if it's investors, they're looking at, if we are to invest our resources in this company, are we going to be able to generate revenue? Are we going to have return on our investment in this particular entity at the end of the day? So financial information would help this group of people to make such an informed decision. So it's either they can get to a decision to invest or rather to provide their resources to the company, of course, depending on the status of the financial reports produced by the reporting entity. So if they are more positive, obviously, then yes, provision of resources can be possible. If it's not, then obviously they might not receive the provision of the resources that they require. Limitations of general purpose of financial reporting. So these are some of the limitations. Like I said, these questions you can be, these things you can be tested on a quiz question. So what are the limitations of general purpose financial reporting? Only provides financial information. So when you look at the set of financial statements, it only provides financial information. There's nothing about risk management given there. Nothing about business sustainability given there. It's all purely financial information that you see. And it's not designed for all users, not designed for all decisions. Because usually when decisions are made concerning financial statements, it's all about provisions of resources. See. But if we're looking at, for instance, you're looking at the government regulators, for instance, maybe from the side of health and safety. I mean, if they look at the financial statement of the company, that will not give them anything to do with financial, with health, what is it, OHS, operational health, what? It's called what? OHS, operational health and safety, yes, operational health and safety of the organization. So by looking at financial statements alone, you cannot be able to say there's something about operational health and safety that is conveyed from that. Hence, we are saying that it's not designed for all users and it's not designed for all decisions. And not exact information sometimes is provided in the financial statement. Why? Because financial statements can be cooked. Say, for instance, a company wants to acquire a loan from a bank and they know very well that their financial statements are not looking so good. They would ensure, under normal circumstances, ensure that their financial statements align to the requirements of what the bank wants so that they can be given the provisions of a loan. Is that practical to do? I mean, is that the right thing for them to do? The answer is no. It's not right. It's unethical for a company to do such. But these are things that happen on a daily basis, right? General purpose financial statements. So there are different types of financial statements that you would see. So obviously you've got your variety types of financial statements, such as the statement of financial position, statement of, in fact, let me just abbreviate this. Right, you're going to see it, of course, in the next slide, but I just thought let me do this to make sure that we are on the same page. I know it's not anything new, but something that you already know. So to abbreviate this, what we call statement of financial position, which is SFP. Then there's statement of profit or loss and other comprehensive income. I would usually abbreviate that as SPLOCI. Then the statement of changes in equity, statement of changes in equity, which is SCE, and then the statement of cash flows, SFC. 4 sets of financial statements. Now, all of these will go together with the notes to the financial statements. So far, so good, sir? So to go,
Still on board.
Wonderful. So to go together with the notes to the financial statements, which we're going to talk about as we proceed. So these are 4 important set of financial statements of note. What do you see in the statement of financial position? This is where assets are disclosed. This is where equity is disclosed. And this is also where liabilities are disclosed. What would you find in the statement of profit or loss and other comprehensive income? This is where incomes and expenses would be disclosed. And notice when you're saying incomes and expenses, we are talking about income, actual income received, as well as accrued income, meaning income that you're still going to receive in a later date in future as a result of what has happened today, or that has happened historically. That's accrued income. Same thing with expenses. We're not talking about only the expenses which you have actually paid for in cash, but we're also talking about accrued So I'll just say here actual and accrued, either accrued income or accrued expenses. That's what you're finding in the statement of profit or loss and other comprehensive income. In the statement of changes in equity, it's literally everything to do with equity. And just another thing though, we are not going to discuss about that here. It's drawings. That's what you find in the statement of changes in equity. And then in the statement of cash flows, look, there are only two things there. Inflows, so if we're talking about inflows, we're talking about actual money received, so that's income. And we're also going to be looking at outflows, which is expenses or expenditure rather, that the company has incurred. So hence I'm just breaking it down as inflows and outflows. So, but if it's inflow, it can either be inflow as a result of income coming into the business, but also it can be inflow as a result of an asset coming into the business, depending on what nature it came through. So hence here I'm just saying inflows and outflows, but we're not going to talk about this for now in a greater detail, right? We're going to focus more on these ones: assets, equity, liability, income, and expenses for now. Right, so far so good. So that is to summarize this. So of course, the financial statement conveys information about the reporting entity, only those economic resources that meet the definition of an asset. So hence I mentioned we're going to talk about assets, we're going to talk about liabilities as well as equity. And then of course we are going to talk about incomes and expenses. Right, so let's proceed to the next part of this so that we can try to cover as much as possible. These are general purpose financial statements, which is what I've already explained about. Statement of financial position, what it conveys, and then statement of financial performance, which is the SPLOCY that I mentioned about already. So it discloses incomes and expenses. Right, so I've already explained about that. Now let's look at the qualitative characteristics and constraints, right? Qualitative characteristics of financial statements and their constraints. So there are two fundamental qualitative characteristics. So these are qualitative characteristics that are expected to be evident in the financial statements that a reporting entity produces. Number one, the financial statements should be relevant. In other words, there has to be a certain source of form of relevancy in it, and it has to be done in faithful presentation. We need to say that the information conveyed there should be truthful and in all honesty. We're going to talk about that, of course, progressively. Steps followed in applying the fundamental characteristics. Step one, identify the economic phenomenon. That is the potential to be useful to the user. That's number one. Number two, you identify what type of information will be the most relevant. And number three, determine whether the information is available and can be faithfully represented. Meaning to say, whenever something is reported in the financial statement, first of all, it has to be relevant. Like for instance, if I'm to put salaries and wages in the statement of profit or loss and other comprehensive income, there has to be employees that should be existent in that organization that are being paid salaries and wages in order for us to achieve faithful presentation. Otherwise, if the company has no employees and we have got salaries and wages that are portrayed in the SPLOCY, then that would be a violation of faithful presentation. And in other words, also it might mean that it will be irrelevant for reporting, for financial reporting purposes. Why? Because how can you report something that does not exist? Do you get the sense?
Yes, I do. Yes, I do.
Yeah, right. So that was fundamental qualitative characteristics. Then there's what we call enhancing qualitative characteristics. So you just need to remember that with qualitative characteristics, two groups. You've got fundamental ones, which is relevancy and faithful representation. And then, of course, you've got enhancing qualitative characteristics, which are four in number. So you've got the comparable. So financial information should be comparable, verifiable, understandable, and should be produced on a timely basis. That's why, for instance, look, we can compare financial statements from one year to the other. if you look at integrated reports of actual companies that are existing today, if you just go to the integrated report, you'll discover that they would show financials. Let's say it's the statement of financial position. They would have one column showing for one particular year, maybe 2024, and then there might be another one showing 2022, 2023, and maybe 2021, depending. Why is it so? Because they're trying to achieve this comparability, qualitative characteristic of financial statements. Verifiable, meaning to say, if I am looking at if I'm looking at the financial statements, right? For me to achieve verifiability, there has to be some form of source document that validates what has been reported. So remember, your accounting process starts with the source document. It goes to your journals. After we've put the information in the journals, we capture it in the general ledger. From the general ledger, we have to capture the information in the trial balance. From the trial balance, then we have your financial statement. So I'm going to give you an example, my brother. Say with salaries and wages, right? So with salaries and wages, what's going to happen is it's going to be captured in a journal called what? Salaries and wages journal. Salaries and wages journal. Now, you would see that this process happens on a month-by-month basis. So for us to get to the annual figure, because usually that's what will be captured in the financial statements, is the annual figures, right? So now, for us to confirm that the salary is paid for the 2024 financial year of the company, say maybe it was, I don't know, maybe 2 million rands. For us to confirm that 2 million rand, or to verify that it's indeed 2 million rand that the company incurred on salaries and wages, we should be able to vouch back to their source documents, which is their salaries and wages journal. So when you're saying that financial statements are verifiable, it means that there is some sort of records that exist which we can be able to verify whether this information conveyed in the financial statement is true or not. And that's where trial balance is coming. Generally just comes in. Journals and source documents also come into the picture. So in video B, my brother, we'll be continuing. You're connecting shortly, and then we continue to discuss video B of the very same lecture session. Thank you.
Okay.
Yeah.
Okay.
So you just connect on the same links, so that it's showing on my side here that we're left with a minute before it disconnects.
All right.
Yeah.